Welcome, everyone. I'm Angelo Robles, and welcome to At Family Office. And for my members of SFO Continuity, welcome. Today, we're going to cover a very deep and very critical, hopefully to all, but really to single family offices, measuring success and managing risk, data-driven solutions for family offices, data, discipline, and accountability. Some of my big three. This is a family office must watch. In today's, what I would say, rapidly evolving investment landscape, family offices face unprecedented risk from counterparty vulnerabilities to liquidity challenges. How can they ensure that their portfolio aligns with their investment policy statement, asset allocation strategy, and long-term goals? Imagining things like quantifying and managing risk, measuring performance, and really holding stakeholders accountable. Let's make your family office more disciplined, data-driven, and successful. So on that note, I'm welcoming back an old friend. I haven't seen him in a long time. Sam Wan, how are you?
I'm good, Angelo. Thank you for having me on your podcast.
It's a pleasure, and I really look forward to it. And admittedly, this is probably more the hardcore deep dive into single family office topics of importance. But hey, the name of my company is SFO Continuity, and single family offices are my life. So why don't we get right to it? There's the old adage, probably by Peter Drucker, but repeated really by everyone. You can't improve what you can't measure. You have a little bit of a take on that, but I think that will help set the stage for the importance of today's conversation, if you don't mind.
Thank you. Just to contextualize things, because I think context matters. For your listeners and your members, I just want to share my background so they understand the vantage point from which I'm coming from. So I worked on Wall Street for many years as the front office chief risk officer for trading and capital markets. And what that job really is, it's similar to being the pit boss at a casino, meaning that I was the guy who decided how much of the house's money, when we were doing either trades that required us to risk our balance sheet, or we were doing proprietary trades because we saw opportunities as the markets were moving to bet our own capital. So that was my one of my jobs. The other job that I had was, before the trading day was over globally, my team and I, we would hedge the trading books overnight or for the week or the month, depending upon what we thought the volatility and the horizon in terms of market risks looked like. So that's how I started my career. And then I moved over to the alternative investment industry and did that at Citi Alternative Investments, which was about $61 billion of private equity, real estate, private equity, hedge fund, and fund of funds. And then I finished my career on the alternative asset management side by being the partner, chief risk officer, and head of data and strategy at a $10 billion Tiger Cup that was both a hedge fund and a private equity fund. Following that, I launched GRMA Inc., Incorporated, where we work with both asset managers and asset owners, and we do one and only one thing, and that is we focus on investment data aggregation and analysis and reporting and monitoring. We don't sell investment ideas. We don't do asset allocation. We're completely neutral because we work with both asset managers and primarily institutional investors, which generally the definition is endowments, foundations, and pensions, and those family offices that take a more institutional approach. So now that with that as the context, I'm happy to talk about investment risks, and in particular, credit or counterparty risks, if that's a subject that you want to focus on. The markets have become more volatile than ever. Family offices who arguably led the way in terms of being the first investors into alternative investments still typically have huge allocations to alternative investments as well as liquid investments. And what we typically see from many family offices is they might have money invested in 20, 30, 40, 50 different places. And they have a nice little old lady or old man that is sort of a low-level accountant or bookkeeper type that opens statements from these various investments or places that they have their money being managed. And they enter into a spreadsheet the current NAV and the current performance. But other than that, they have no idea what the investment risks are in their portfolio. They have no idea what the credit risks are, what the counterparty risks are. They have no idea where their liquidity is because entering the current NAV and the performance into a spreadsheet is not going to tell you these things. So one of the things that I would strongly recommend is that family offices, when it comes to managing the risk side of their investment portfolios, that it is very much in their best interest, given the size and the dollar amount of their investment portfolio, to take a more institutional approach. So that's the first place I would suggest they start.
Well, I mean, that goes back a little bit to my opening comment when I introduced you. You really cannot improve, as Drucker says, what you can't measure. Your little twist to that is you really can't manage, quote unquote, what you can't measure. So you broadly covered the subject. Let's dive in a little deeper. What are the most common risks that family offices overlook, and how do you help identify those risks?
Great question. So for most family offices that we see, and it depends what definition we use for quote, a single family office, but as you're aware, the generally accepted definition for who constitutes or who qualifies as a family office is having investable assets of at least north of 150 to 190 million. So depending upon who you talk to, that would be sort of the minimum threshold. For those that fall below that, I say job well done, and you are much better off than the majority of the population. But generally, you would fall into what the banks would consider high net worth or ultras, but you would not qualify for what is considered a family office. So for family offices, in their investment portfolio, they generally do not need that to spin off like an endowment client of ours or a foundation, where they need a percentage of the return from those investments to support the endowment or the foundation or pensioners. So from that perspective, they are less vulnerable to market risk. And the definition for market risk is generally considered price risk, meaning the price fluctuations that up or down that go with having an investment portfolio, whether it's liquid investments or illiquid investments like private equity. So on a mark-to-market basis, those things are going to go up and down. In volatile and in stressed markets are going to go down. So as an example, during the great financial crisis, we had S&P, which are the largest 500 stocks in the globally. Those go down over 28%, right? So on paper, you had a loss of over 28% in S&P. However, since most family offices are not looking to, they don't require their gains or losses from the investment portfolio to, say, pay for their living expenses, they're not immediately affected by those things. However, from a investment management perspective, obviously, that's a big hit, even if the markets are going to rebound over time. History showed us that it took, depending upon how you want to do the math, 5, 6, 7 years before those losses recovered, because you need to double that amount just to get back to where you originally started. So the risks that most family offices are concerned about center around liquidity risk, center around credit and counterparty risk, and they also center around reinvestment risk. So when investments mature, and let's say those investments were returning a very attractive return, you can't necessarily replace it with something with the equivalent return profile or better immediately. So those are the risks that often when I speak to family offices, they're more focused on is liquidity, credit counterparty risk, and reinvestment risk. Of course, they care about market risk, because if they see that their NAV has dropped dramatically, don't get me wrong, they're not nonplussed or do not say que sera about that.
Of course, I think liquidity risk is pretty straightforward and easily understood, although sometimes more overlooked depending on certain circumstances, including for dry powder and opportunities to purchase more than we would probably want to admit. But I think the one that I want to focus on a little bit are some of the others that you noted. How do you assess the vague term, and I've been using it more as well, of counterparty risk? What does that mean to you, and why should that be important for family offices?
They should care about counterparty risk because it has a direct impact on a lot of the investments within their portfolio. So let's divide the portfolio into segments. So if we divide the portfolio into what would be considered the risk-free segments, the risk-free segments would be generally government bonds, obviously US government bonds. So those are considered a zero risk investment. So if you have investments in T-bonds, as an example, from a credit or counterparty risk perspective, those are considered zero credit risk or zero counterparty risk because they're backed by the full faith and credit of the US government. Unless you think the US government is going to go under, in which case we have a much bigger problem, because it's the same reason that foreign nations also buy US government bonds, because they're liquid and they represent the risk-free investment. So if we separate those immediately as being the investments in a family office's portfolio that are risk-free, then we're left with the next tier of investments, which would be considered have secondary credit or counterparty risk. And those would be high-grade municipal bonds, high-grade corporate bonds. And when I say high-grade, I'm talking about ones that have, a single A, double A, or triple A kind of rating. So those, I would say, and as witnessed within the financial crisis, spreads did widen. But and when I say spreads, I'm talking about the spreads between government bonds or the risk-free rate and all other investments. However, we did not see in any significant or material way defaults in the various high-grade investments, whether it's high-grade corporate bonds or high-grade municipal bonds. So that would be the second strata of things that have de minimis. So I'm not saying zero, I'm saying de minimis credit or counterparty risk. So once you separate those, what you're left with are equities, which are stocks, and then you're left with alternative investments generally. And with equities, there is a tiering of those as well. And generally the way the credit and counterparty risk for equities is tiered are by names and the credit quality of those names. So the names that are in the Dow, as an example, so names like JP Morgan or Apple, those most credit analysts would say have de minimis credit or counterparty risk because of their balance sheets, because of their revenues, because of the cash they have on hand. So none of those companies took a serious or permanent hit during the great financial crisis. So once you ring fence those names that are in the Dow and the S&P, and you start to go down in credit quality to mid cap or small cap names, then you start to see credit and counterparty risk. And it's going to vary from name to name because not all mid cap, not all small cap stocks are alike. There are higher quality names and there are lower quality names. And in most family offices, because of the yield opportunities they present, they're going to have investments in mid cap, small cap, and also I forgot to mention international equities, and those are not all the same. And so all of those investments really, if you want to understand your credit and counterparty risk, need to be separated, just like you don't want to put in, clothing that is red colored with your whites, right? We know what's going to happen. Even if you wash that in cold water, you run the risk that it's going to bleed. So the family offices that are not taking an institutional approach have no idea what percentage of their portfolio is in investment or non-investment grade. And even within the non-investment grade, there are various levels and strata of credit and counterparty risk, and they have no idea because it is not being analyzed, it's not being measured, certainly not being monitored. So that spreadsheet that I mentioned that just has the current NAV, maybe the inception date of when they invested in it, and the current performance is not going to reveal your credit and counterparty risk as I'm mentioning now. So then if you go into the alternative investments, there's a wide range from real estate to buyout to venture, et cetera. And so the credit and counterparty risk is going to be all over the map. And I would argue that most family offices have no idea, just like they have no idea in their liquid investments what the credit counterparty risks are. They have no idea what the credit risks are and the liquidity risks are in their investments in things like private equity, private credit, private real estate, et cetera. So at a high level, right now that I'm talking, which is 15,000 foot elevation, as we start to get into it, this picture that I'm painting should resonate with people that are listening. And hopefully they're having that moment where they're saying, the speaker, in this case, Sam, is right. We have no idea what our credit risks are and what our credit exposure is and what our liquidity risk is.
100%. From my experiences, 20 years in the community, the combination of counterparty and credit risk is woefully underestimated. That doesn't always mean it's going to come up and blow up in your face. Actually, for the most part, depending on a variety of timeline factors, probably not. But the fact that it's there and you're not mitigating it, understanding it, and managing it is somewhat, in my opinion, concerning. And you mentioned a really big one. And I'm making this up, you're an LP in 9, 10, 11, 12 different funds. You broadly know what they do, but are you really tracking some of the underlying holdings through a 13F, through other technology resources that could see through and evaluate what percentage of your portfolio? Now, we could take counterparty risk a step further and talk about systemic banking risk. Oh, that never happens? Well, yeah, it did just a couple of short years ago when it seems like we weren't expecting it. And there's a lot of other factors. So that is a complex risk that most families effectively elect to put their head in the sand, but that's not the correct approach. Why don't we go a little deeper? You're going to need some tools to be able to kind of see and evaluate, which I just hinted at, some of these risks, including liquidity, but certainly others. What sort of resources are available and how have you utilized them to be more analytical and metric driven in your approach?
That's an excellent question. It becomes what I call the compare and contrast. I think for a lot of people, since they have an idea of what they do, and they may have a suspicion what they do is overly simplistic, and they don't know what their investment risks are, whether it's market risk or credit risk or liquidity risk. So to give you the compare and contrast, as I mentioned at the top, the family offices that are taking an institutional approach, and I want to define terms. What do I mean by institutional approach? What I mean by institutional approach is they're taking an approach that is more similar to what an endowment or a foundation or a pension does in terms of measuring, monitoring, and managing their portfolio. So I call it the 3Ms or M cubed. Okay, so I'm showing how geeky I am. So in order to do that, what we do for institutional grade family offices, we also do it for endowments, foundations, and pensions. We use the same template. The first thing we do is wherever you have your investments, whether it's with a mutual fund or whether it's with a private equity fund, we get the permissioning from the institution or the family office to pick up on a regular basis the data regarding your holdings in that fund. So the typical sources of where we pick up that data could be a custodian bank, like BNY Mellon or State Street. Some family offices use those custody banks, or it could be directly from the manager themselves. So the family offices are often not aware that, because they don't ask, that if they're invested with a particular private equity fund or particular hedge fund, if they permission us as their vendor, we can pick up data that is more granular about their investment portfolio. And we'll do that at the 30 or 40 or 50 or 100 places that they have investments. So the first thing we do is extract and aggregate that portfolio data. Once we extract and aggregate that portfolio data, we can normalize the data. And normalize is just a fancy IT term for sort and tag and group the data. Once we've done that, we're able to run it through various calculation and analytic engines to analyze the data so we can determine things such as how much of your investments that are in 50 different places fall under no credit risk, such as US government bonds. In contrast, how many of your investments, not only in quantity, but in dollar amount and NAV, fall into, say, junk bond category, right? And there's nothing wrong with having investments in junk bond category, but you have to know that that high return you're getting on a junk bond portfolio is not a free lunch. It comes with it that a lot of those names in an economic downturn or widening in spreads for bonds can go under. And if those names in that junk bond fund go under, what do you think is going to happen to your NAV? What do you think is going to happen to your return once some of these names start to default? So we have to aggregate, normalize, and then analyze the data. And so what the family office would receive on typically a quarterly basis would be a report that shows them a profile of their credit risk and their counterparty risk. And so if you can imagine a pie chart or a bar chart, it will say, X percentage, 22% of your portfolio is in government bonds and Dow and S&P names. So we consider that very low credit counterparty risk. However, a third of your investments are in names that if there is an economic downturn or certainly another financial crisis where you could take a hit because they are in lower credit quality names. And by the way, X percentage of your portfolio is liquid and Y percentage of your portfolio is illiquid. And furthermore, we have stress tested your portfolio. So under different economic and market scenarios, here's what kind of drawdown you could expect to see in the portfolio. Even if you don't realize that drawdown on paper, what would be your loss? And then obviously, if you were to draw from the investment portfolio, you would be realizing that loss. So having these metrics, having these tables, having these pie charts that specifically tell you what your credit and counterparty risk is. And for that matter, I want people to understand that it's not just backward looking, it's forward looking in the sense that to the extent that you have any new money that you want to put to work, let's say the family still has an operating business that throws off money. And so from time to time, there's money that you're going to be putting into savings or into the investment portfolio. Well, as you make these additional asset allocation decisions, don't you think it would be good to know how much you have in high quality credits, low quality credits, liquidity risk, or for that matter, what percentage of my portfolio is in healthcare versus industrials versus financials? Well, if you're not measuring this stuff, you have no idea. So what we see family offices doing is the unintended effect is they are making additional investments, not knowing that they're maybe doubling up or loading up in areas that they shouldn't be, and in other areas where maybe they should be making an allocation because they really don't know the credit makeup or the industry sector makeup of their investments, especially when you put together both the liquid and illiquid investments, right? They are making these bad decisions and poor decisions, which often just exacerbate some of the market credit and liquidity risks that underlie their portfolio and their investments.
100%. And I mean, that goes even a little deeper and still diving into counterparty and credit risk in general. A lot of managers, they stray. And if you don't have an X-ray to look in terms of technology, in terms of what they're investing in and how it fits into your investment policy statement and portfolio, then, I mean, honestly, you're kind of breaking the rules of the investment policy statement if you want to take that very literally. You also have issues where I think the work that you're doing could pick up some degree of irregularities, which may be an honest mistake or maybe something a little more devious. And then there's other programs on doing on counterparty risk with auditors and accountants that would then maybe take that a step further just to make sure. We all do understand not everyone is a good person and there are bad things that happen. And sometimes they're not devious, but they're mistakes. And you want to be very clear that what you're investing in is exactly what you know to be investing in and that you're getting the stated return and the structure of fees that is stated to you by the underlying fund. And henceforth, you're a great earlier stage in terms of picking up some things that might be a little bit off. That probably segues into my next question pretty well. And that relates to investment policy statements. The opportunity for a family office representing the family or entities within the family, so it may be more than one quote unquote investment policy statement that outlines liquidity, risk tolerance, goals, timelines, etc. Therefore, by measuring properly, you're able to understand, hey, we're getting outperformance in the last quarter, the last year. Our investment policy statement limitations are now askew on public equities, on real estate. We may need understanding tax risk to adjust, to reallocate. How do you weave in the importance of an investment policy statement with the underlying work that you're doing to make sure that it fits within, I'm going to say the word, a fiduciary standard?
That's an excellent question and topic that should be covered, and I'm glad we're covering it in today's podcast. I think if I look at some of the family offices that we've encountered or have had experience with, there's a common pattern, and that is depending upon whether, especially for the family offices where there is a generational wealth component in place, we'll see that there is an elder family member, patriarch, let's say, grandfather, who has either appointed himself or family members have appointed the person, officially or unofficially, to oversee the family office portfolio of investments. And this person, generally, their intention, of course, is very good. They may have been responsible or a party to the generation of that wealth. So they feel that besides being an older member of that clan, that they are best equipped to manage those that investment portfolio. That may or may not be the case. But what often that patriarch does not understand is that they have a fiduciary responsibility. And we have seen family offices, and people have probably read about it, where members of the family, either immediate family or cousins, sue for breach of fiduciary responsibility because somebody, even if it was not their intention, they had mismanaged the investment portfolio. So if you were to ask me the percentage of family offices that have a formal written investment policy statement, from our experience, we would say it's certainly less than 30%. What a lot of these other families will tell you is they have it, but it just hasn't been memorialized. Okay. And so that's problematic. So let's start with the people that have memorialized it. We often see that in the families that have memorialized it, if you ring fence or exclude the families that are taking an institutional approach, the majority of those families that have written down something, it would be, if you were to submit that for a grade as to where the investment policy statement sits on the spectrum for completeness, for having the proper elements in it, it would probably get an F. So basic things that touch upon things like liquidity, credit, counterparty risk, market risk are going to be conspicuously absent. Why are they absent? It's not that necessarily because the family has never heard of these terms, but it goes to the fact that they are not measuring these things. And because they're not measuring these things or cannot measure them, you can't monitor them. And if you can't monitor them, they're not, you're not measuring and monitoring them, they're not in the investment policy statement to start with. So the investment policy statement typically has just a general guideline on asset allocation to things like equities, to bonds, to alternatives, and has something that says to the effect that if the person who is responsible for doing this or managing this, the portfolio I'm speaking of, that there is some protocol in place as to the fact that Uncle Robbie would take the place of Grandpa John, who is doing this. But the investment policy statement is so short and so vague and so limited that it could probably fit on a 4x6 card. And so that's what we typically see. And so if you want to have an investment policy statement, because I don't want to just make critiques, I want to offer a solution. And if you want to have an investment policy statement that is actually a document and a guideline and a roadmap, there are many different elements that it needs to have. It needs to talk about various investment risks, such as market risk, such as credit risk, such as counterparty risk, such as liquidity risk. And there needs to be percentiles, and there needs to be reporting that is going to be shared with the family office members or the constituents so they can see where the portfolio is in aggregate. So the number one thing I hear from family offices is that they do not have an aggregate understanding or picture of their investment portfolio, because they say we're invested with 40, 50, 30 managers. And that's when I say there is a solution to that if you want to take an institutional approach. And they say, oh, yes, we'd be interested in knowing what that is. And then we say, there's some work that has to be done. The data has to be aggregated. You're going to have to do some work and actually get family office members or constituents to agree on these limits. And then you're going to have to pay a fee for somebody to aggregate and analyze this data and generate these quarterly reports. And then generally, once you tell them about this work and the fact that to protect a $200 million portfolio, they might have to spend $100,000 a year, you'll be surprised at how many of them are penny wise and pound foolish and say that they'll give it some thought or it's not for them. When they just got through telling you that there are these huge voids and that they should tell you that they agree that they're flying blind. And that's when I try to convince them or ask them the question, do you own a home or multiple homes? And they look at me like I have 5 heads and they say, yes, of course. And then I ask them, do you have insurance on these homes? So if there's a fire or a flood, and they say, yes, of course. And then I ask them, well, how much are you spending for insurance for your house? And they say, oh, thousands and thousands of dollars. And I said, well, which is the bigger number, the value of your house or the family's investment portfolio? And they say the family investment portfolio is 10 times, 20 times, 30 times, 40 times the value of their homes. And I say, that's interesting. You're willing to spend money on a $10 million house and have insurance, but on a $200 million portfolio, you want to fly blind. You want to have no reporting. You want to have no idea what your credit or counterparty risks are. Does that make sense? And they sheepishly say, no, it doesn't. We'll give this a think. And then of those people that say that we'll give it a think, we hear from about 5 to 10% that they say, we need to act and we need to act now. We need to have understand what our investment risks are. But I would say the 90%, you never hear from them. And they just go back to this simple spreadsheet that has the NAV at 30, 40, 50 places, and they continue to fly blind. And there's a certain entitlement that comes from being that lucky, that fortunate, and having that kind of wealth. They assume that they're impervious because the amount of wealth that they have, they figure that they'll be okay. And so there's a false optimism that comes with the entitlement of wealth. And I'm just want to be as direct as possible and candid with your listeners.
Sam, you're preaching to the choir. My audience knows it. I mean, I make them mad as well. I don't understand how you could be an investor, in my opinion, even an ultra high net worth investor, and not have a game plan, which the framework of that is going to be your goals and really going to be within the investment policy statement. And honestly, for some families, larger, more generational, varying trust, various assets more applicable to a specific family member, you really want the truth, you probably need multiple investment policy statements. It allows you to understand the goals, to understand the risk, and to stay disciplined within certain parameters. And absolutely, if done right and updated and engaging properly the members or the participants, the recipients, it absolutely helps to hedge against litigation, which in my experience around the world for 20 plus years in the family office world is practically inevitable from this investing perspective if you don't end up doing things right, let alone you have clarity in terms of what your goals are and where you're headed. That alone should be enough to drive people to do it. Yet somehow it gets either antiquated or more likely, like you said, not done at all. Let me ask a related question. And these next couple of questions are going to kind of all tie together. What role does reporting, financial reporting, play in ensuring that family offices meet their strategic goals? I gave an example of, well, good for you. I'm making this up. The mid-cap did incredibly well. It now exceeds the parameters in your investment policy statement. One, do you understand that? Are you going to let it run, but it's not really within your investment policy statement unless you have good reason to change that? And do you know how to sell what's going to be most tax advantageous, first in, first out, a variety of different factors? If you don't have the technology and metrics that measure that, how are you going to make proper decisions?
No, that's a great question. So one of the two biggest elements for families, if they want to take an institutional approach to managing their investment portfolio and investing for the future and for future generations, they must have a robust IPS or investment policy statement that covers credit, counterparty risk, market risk. And not only that, it also should have an escalation policy. So if certain things go awry from what the family members have agreed to, what is the protocol for defeasance? Mm-hmm. So I'll give you an example. During the financial crisis, those people that decided, hey, this is not your everyday flood, and decided to move some of their money, even though it meant painfully taking a loss of 15%, 18%, guess what? They did better than those people who said, you know, this can't certainly get worse. Well, it got worse, right? So risk defeasance needs to be in the investment policy statement. So I'll give you a parallel. Let's say you experienced, unfortunately, in your big house in the country, a fire. And the fire was no big deal. You were able to put it out yourself with a fire extinguisher that you had in the basement of the house. There was a little smokiness. Windows were opened. Nobody was injured. In fact, the fire department didn't need to come. 10 years goes by, and not in that house, but in another house, there's a fire. You can't just presume that you're going to be okay. You're not going to call the fire department. You can just, throw a pail of water on it or something, which, by the way, I don't think is advisable if it's a fire caused by a short circuit and it's an electrical fire. I'm not a fireman, but I don't think you're supposed to throw a bucket of water on an electrical fire. So one experience that you had does not necessarily mean it equates to another experience. So that first required element of an IPS has to be one that is quite detailed and has risk defeasance and has escalation procedures that are in it, besides covers market risk, credit risk, counterparty risk, liquidity risk. And it should show you it should have details about allocation parameters to various industry sectors, to various investment grades. That should all be in there. But in order to execute upon this IPS, even if you have the best IPS, if you don't have the detailed reporting that you're getting on a regular basis, obviously the IPS then becomes worthless because then it becomes just a aspirational document, but not something that you're executing around. So in order to execute on that IPS or investment policy statement, you have to have that regular reporting that shows you how much is my credit risk, how much is my liquidity risk, how am I doing in some investments, where am I over allocated, where am I under allocated, and in which industry sectors, which geography. A good report, risk and performance report, will have that. And the other thing that's very important that we didn't talk about is family offices can be very ignorant about looking at performance. So I'll give you an example. You have two investments, and one investment says that for calendar year 2024, it yielded 11%, and you have another one that says it yielded 11%. So for a typical family office, they'll say, those are the same. But guess what? They're not. Because if investment A required twice as much risk to generate it, while investment B was, let's say, government bonds, obviously, those should not be looked in the same light. So one of the things that I try to educate if we have a teach-in for a family office is trying to dispel this notion of absolute return, and they need to look at risk-adjusted return. So in other words, what is the unit of risk that was taken to generate that unit of return? Mm-hmm. Understanding that is important for not only understanding your existing portfolio, but making future investments, right? And so that is an area where woefully, I would say 98% of families are totally ignorant. And part of the reason they're ignorant is they have no metrics, no reporting that differentiates that for them, because that's not a calculation you can do in your head. I don't care if you're Mensa smart, you can't look at your investment, eyeball it, and say investment A is twice as risky as investment B. Now, sometimes people say, how do you measure the risk of investment A versus investment B? Well, we do it on several metrics. One is on volatility. Volatility means how much does investment A move up and down. That's one metric that is used to judge market risk. Another metric that is used to judge the risk is the credit risk. And the credit risk can be determined by things such as what is investment A's S&P and Moody's rating versus investment B's S&P and Moody's rating. Well, guess what? When you get your statement from your manager, they don't disclose that, right? And they don't disclose it because they know, but it's extra work, and they want to leave things kind of opaque, because if you have too much information, you may decide that on a risk-adjusted basis, the return, even if it's positive, that they're generating for you is really not that great a return on a risk-adjusted basis. So what we do is, if we see that you're invested in investment A and investment B, we go use our market data subscriptions, and we do the research, which takes, when we do it systematically, about 2 seconds. And we pull down the latest investment rate grade rating from S&P or Moody's or both. And we'll say investment A is a double A investment. Investment B is a junk bond investment. So you can't treat the two returns the same. So again, this gets back to why the reporting and why also having an aggregate view of your investment portfolio is so needed. Because if you don't have that aggregated view of your investment portfolio, you may not realize that every time you hear about or you make another attractive investment, you're adding to the already existing investments that you have in financials or in technology or healthcare, and you have no idea that you have too much of a weight there because you have not aggregated that data, and you have no idea how much weighting you have in those areas, because all you're doing is simply taking the latest NAV and the latest performance and putting it into a spreadsheet with 2 columns or 3 columns. The name of the investment, the latest NAV, and the latest performance. Well, guess what? Those 3 columns, surprise, surprise, aren't going to tell you what your credit risk is, aren't going to tell you that you're overweighted in certain sectors, aren't going to tell you that you have an unusually high percentage of investments that are below investment grade that have lots of credit and counterparty risk. And that's the reason that the last couple of quarters, you might have been getting like brag-worthy, on paper, absolute returns. But on the other hand, there's also a ticking time bomb that then when there's a market downturn, a lot of these investments, which historically can default, what do you think your return profile is going to look like when these investments default?
Well, those are all great questions to be asking internally, Sam. And for those of you that may be wondering, Angelo, didn't I hear you do a debate with fellow industry pundit Jamie McLaughlin where you were a little poo-pooing investment policy statements? That would be incorrect. I'm a huge advocate of having an investment policy statement. If anything, like I hinted, I believe for especially larger, more multi-generational families, they probably need multiple. What I do believe, now, maybe because I'm more active in my allocations and investing, sure, but I think if you have a single family office that has somewhat of an investment focus, I do think they should be able to build out, address, and make it applicable in-house, that you don't necessarily need Wall Street. Although perhaps some of you, depending on the focus and quality of your family office, may use a little bit more rigor relative to that. A question came in, Sam, prior to my interview with you. It's not perfectly aligned up your alley, but it's somewhat in what we're talking about now. How do you approach benchmarking performance against industry standards or goals? We could go in a lot of different directions here with that somewhat vague and open-ended question.
No, so far we're in agreement on everything, but it's not true. We do a lot of work in the reporting that we do for the institutional family offices in benchmarking. First, using the right benchmark, because you need the benchmarking in order to come up with the risk-adjusted return. So otherwise, we would just be pulling numbers out of the air. So the way we do it is through proper benchmarking. So I'll give you an example. We see family offices that simplistically look at everything in comparison to the S&P. Well, that is patently ignorant and wrong. Why would you look at mid-cap stocks when you have the Russell index, which is a mid-cap index? And so why would you benchmark mid-cap stocks to the S&P when it should be benchmarked to the Russell? Why would you benchmark private equity or a hedge fund to the S&P when there are benchmarks for today? I think a lot of family offices are not aware that even within the hedge fund category, there are benchmarks for event-driven long-short equity versus global macro versus systematic. So they're I think everybody's familiar with the expression apples to apples. If you want to do apples to apples, which is absolutely needed when you're looking at investments and you're looking at it through the right lens or the filter, the benchmark is very important. And then to give you further understanding, for our institutional family offices or endowments, foundation, or pensions, what we also do is we do a blended benchmark. So based upon the respective weights and individual benchmarks, we use some math to come up with a blended benchmark for the aggregate portfolio, because the aggregate portfolio is the combination of things like equities, bonds, private equity, etc. And so you need to have that blended benchmark too. Now, all of these comparisons are important for truly understanding what the true return and the true risk-adjusted return is. So benchmarking is very, very important. and selecting the right benchmark, calculating it properly, and then also adjusting for the risk element. Because guess what? The risks for the benchmarks are different. So the risk of the Russell Mid-Cap Index, even if you had an index fund, is not the same as the risk or the volatility of the S&P or the Dow.
For sure. And no, I'm definitely in terms of on board in what you're saying. That also goes a little both ways. You may be invested as an LP, and they're giving you a benchmark that may make them look a little more favorable than the reality of what they're investing in.
That's
and
right.
What should be the benchmark. Really hard to believe, LPs, but sometimes GPs stretch a little bit of your perception to make them look better. So you have to be very realistic from that perspective as well. I do have some strong opinions about the subject that are a little contrarian, I guess you could say, but that would be a deeper dive in that subject for another hour or two at a different time. How do you use it? You've given us an idea, but how do you use the technology to enhance the ability to hold investment managers and advisors accountable?
There's two ways we do it. And so the first thing is I recommend is the way you do it is on a data-driven approach and not on a hunch. And so we see too many family offices that do things based upon intuition or a hunch and not based upon data. And so in order to hold your GPs, right, or managers accountable, the benchmarking is very important. Understanding what your risk-adjusted return is very important. And also a topic that you glanced upon earlier during this discussion and conversation is when there's style drift. A lot of LPs or families that are investors in alternative funds, as an example, where we see it the most, don't understand that when they sign the 50-page PPM, the product program, and the legal docs, that in those documents, it often gives the manager two kinds of discretion they're not aware of. One kind of discretion is that they're allowed up to a certain percentage to invest in things that are not their wheelhouse. And so I'll give you an example. You think you're invested with a long-short equity fund, but you don't realize that they can allocate up to 15% or 20% of the total NAV of the portfolio in high-yield bonds. Well, guess what? Let's put aside the investment decision of investing in high-yield bonds. I think high-yield bonds have a place in people's investment portfolio, but only if you can monitor the credit risks, the counterparty risks. And so we've seen a number of families who are stunned and completely ignorant of the fact that their long-short equity manager is actually also holding high-yield bonds. Why is that person holding high-yield bonds? Is it actually related to their strategy around equities, or is it because they just don't have any better ideas and they know you might pull your money if the return aren't attractive, and so they jumped on the bandwagon because high yield bonds are doing well, and they're investing in an area where their expertise is thin, and so there's style drift there. Now, remember, you just didn't realize that buried in the fund docs that you signed that they have the ability to do that. So I'm not suggesting that the manager is doing something illegal, but we often see the LP or the family completely stunned when they find that in our reporting, we show that to them. So You've got to make a decision. Are you okay with that style drift? Or are you going to then say at the next window or opportunity, often hedge funds will have, a tie-up, which you can't redeem for, say, 3 or 4 months. that next window, are you going to put your notice in and redeem because you think the manager is out of ideas if they're investing in high yield bonds? Or do you think that it complements what they're doing? And so you don't mind that they're doing this? It could cut either way. But looking at style drift and holding them accountable, being able to know based upon what the true benchmark is and what the risk adjusted return is, which takes some analysis, that's how you hold people accountable. Otherwise, are you going to do it by whether you like their face or the shirt or the tie they're wearing? Or is that how you're going to make your judgment or accountability decision? I hope not. It should be based upon the data. It should be based upon facts. And so that's the only way to do it. Otherwise, you have no means by which to hold anybody accountable. You're just going to have to go on hope, and hope is not a strategy.
No. The next question came in, could also use a little bit of context, and we could spend hours on the underlying technologies. Are there specific tools or platforms that you believe every family office should integrate into their operations? My little comment about that before I kick it off to you is, one, do you have the internal capabilities with the right staff to be able to understand the technology, how to implement it, and how to use it to its maximal impact? Might you actually be overkilling in certain things? My portfolio is relatively straightforward in public stocks, some land and real estate, some private companies through a holdco. I am not that active just to pinch as an LP. I keep things relatively high conviction and straightforward. For me, I don't necessarily need a lot of the quote unquote analytical tools. But when you aggregate accounting, aggregation, and reporting, and you're a larger scale institutional level family office, do you do it internal? You can make the argument, or do you do it external? An advantage is, one, are your internal people really understanding and maximizing the use of the underlying resources? And all they see is your family. Someone like Sam or others that are good, now that's the definition there, they see lots of different, in theory, they're experts at using the technology that honestly you and your team is probably not going to be as fluid in. How would you add to that or answer that question, Sam?
Well, it depends on the family, because the families where they have, we see, these are the most common setups that we see. We often see a family office where they have a staff of one or two people. They have somebody that was a retired KPMG partner. So his expertise is in accounting, not in investing. They need to keep that in mind. And sometimes they ask this man who is a retired partner or a retired lawyer to make travel arrangements for the family, or to intercede in some issues with a service provider for maintenance of their grounds. And they use them as a jack of all trades, when in fact the person's expertise is limited to, say, certain type of law or just accounting. So, and it also depends upon if they are doing their investing in a fund-to-fund style, meaning that they're just allocating money out to managers, or are they doing direct investments, co-investments, etc. If they're doing direct investments, co-investments, and taking an approach that is more akin to an endowment foundation pension, then they need to consider having more systems and software that they're running internally. Otherwise, these families that have a staff of one or two people, they would probably be wise to outsource that to a reputable and experienced vendor. So what would that be? So as an example, there are service providers or companies that will handle the accounting work, will handle some of the operations work, that have experience. They should do that. When it comes to things such as the IPS and monitoring and doing the reporting, I'm biased, but we're a firm such as ours is best equipped to do it, because we also do it for leading asset managers, And we know what these are, and we don't have an axe to grind, meaning that we're not trying to sell them investments or push them into investments. So it really depends upon the size of the portfolio and what the family office is doing. There is not a one size fits all. What I think is the worst thing that a family can do, though, is what we see a lot of families doing, which is they just sort of wing it. Everything is a sort of ad hoc, improvised, lacks any kind of sort of formality, and again, that's where the arrogance comes in, because they think with that enormous wealth, they're going to be fine, and they also look at it as, well, we didn't blow up last week, so why should I worry about blowing up tomorrow? Or why should a nephew or a cousin hasn't sued me to date, and we all get along, and so certainly nobody in our family would sue me or sue us. So I call it BN, stands for benign neglect. That's the most common thing we see in family offices, is benign neglect and benign ignorance.
And Sam, I think we're heading somewhat to the home stretch and maybe putting a little bit of a bow on it. One or two final questions. Is there one piece of advice you would give to a single family office to improve their risk management? I would say performance, but more measurables relative to their investment portfolio and the risk that they're taking.
Well, I would start with the number one thing when I'm asked to speak or lecture on this topic, which is their frustration that they really don't have an aggregate view of their portfolio. That's the number one complaint. And so my response to that is, if you want to have an aggregate view of your portfolio and you want to manage risk, then you have to be able to measure and monitor. And in order to measure and monitor, you need to, and manage, those three M's, you need to have periodic reporting on a regular interval. I recommend at least quarterly, which gives you a breakdown of where you are versus your investment policy statement, where you're allocated, what industry sectors, what is the credit and counterparty composition, how much of your portfolio is in investment grade versus, junk bond or anything in between that. How much of it is with too much with one manager? If you needed the liquidity, where would you be able to get that liquidity, right? And so in order to answer these basic questions and have the basic understanding of your portfolio, and what is the performance of my portfolio on a risk-adjusted basis, and how does that compare to the applicable benchmarks, as we talked about earlier? To answer these questions, you cannot do it without the data, without the reporting. It's essential. And for those that think they're being thrifty, or they think they're being cautious with their money, you're not. Think about the fact that you probably would not pull, to save money, the insurance on your car, the insurance on your home, right? Why would you have, for your biggest asset, which is your investment portfolio, no insurance? Why would you drive the car that is your investment portfolio with no dashboard, so you have no idea if you're going 80 miles per hour or 20 miles per hour? When I ask those questions in a room with other family offices, I get the look that you get when the family dog has done something they shouldn't have done. They kind of look down, eyes cast, they look sheepish, they look embarrassed, and there's awkward silence. There's crickets in the room. And that's when I know it's resonated. But I also know from experience, and I'm not trying to be glass half empty or pessimistic, I also know from experience that once that discomfort, knowing that that's what they're doing, dissipates, maybe when they leave the room or the conference or your event, they want to forget about it. and they want to continue doing what they're doing and fly blind with no insurance, no dashboard. And so if I can impress anything upon the listeners to your podcast, is that you need to have a robust investment policy statement to fulfill your fiduciary responsibilities, to not have the event of being sued by your own family members. If you really want to have good risk-adjusted returns for the long term, you need to measure, monitor, and have regular reporting. It cannot be done any other way, because all the people that are listening to this podcast have investments that are scattered all over the place with many different managers, many different levels of complexity. And so there's no way that somebody can eyeball this stuff and track it properly in this simplistic spreadsheet with the NAV and the latest performance. That doesn't cut it.
A comment on that, then I'll want to know how families can learn more about you and your practice, Sam. I completely concur with Sam. If we were to dive deeper, there may be some areas where we have some little differences on. For the most part, my life is single family offices. I know perhaps Sam and myself sound a little critical here. That's because we hold the potential of what you could be to such a regard. In theory, you could be the ultimate institutional investors in allocation, because you may not necessarily have some of the limitations and challenges that hierarchy and bureaucracy could bring on. Sadly, most family offices don't reach a level of excellence, but they could. Where I may disagree a little bit with Sam is I think they could actually do it at a lesser AUM than a lot of people think. I think the world has changed, technology, resources, selective outsourcing, and the opportunity and value from a tax advantage of creating a family office, of integrating a holdco and a private trust company. We actually overcomplicate it. And even the investment policy statement, I'm a huge advocate. I'm one of the biggest advocates, actually likely of multiple, which does complicate things. But we don't need to make it harder than it needs to be. Occam's razor, which is another discussion that we could have. So yes, we're holding the fire a little bit to the single family office, or shining the spotlight. And in some ways, it's a little disappointing, but it doesn't have to be that way. There are changes that could be made that are actually not that radical, that could cause significant impact to enhancements in the family office. I love Peter Drucker and Jim Collins. Their work and my obsession with the single family office world has dedicated my work as a membership and a consultant to the community. And these are all principles. It was great to have you on today, Sam. For those that would like to follow up, serious inquiries only, please, and to learn more, how could they follow up with you?
Yes, we're delighted to work with the family offices that want to take an institutional approach, meaning that they want to have a robust investment policy statement, and they're interested in having insurance on their investment portfolio by being able to measure and monitor and manage their investments through regular data and reporting that gives them objective metrics. As I said before, we don't give investment advice. We do not sell investments. And so they can reach out to me directly through phone, or they can go to our website, which is www.grmainc, like incorporated.com, www.grmainc.com, or reach out to me through you, Angelo, or my phone, and we would be happy to talk to them about these topics. So thank you for today's conversation. I think it's a much needed topic. And I'd love to see families make more progress in this area. So the institutional families that want to take that institutional approach, I think the feedback that we've gotten is that Not only are they fulfilling their fiduciary responsibilities, but it's also helped them to make better investment decisions going forward because they know what they're holding. If you're playing a game of cards, if you're going to put one card down and draw another, don't you need to know what is in your hand? So, I mean, it sounds like a corny analogy, but a lot of families, it's that benign ignorance and benign neglect I told you about. They have no idea what they're holding.
Sam, what can I say? You know that I already agree. An audience, I've known Sam for a number of years. He's a true thought leader, very dedicated, very diligent. If you're a family office and you don't realize this could be a problem, or if you're very thoughtful, Angelo, I think we're actually pretty good at it, but maybe Sam is someone either way that I should connect with. And let's see where it goes. I don't see where you have anything to lose, and that's going to be the value of that. Again, the website, as he mentioned, was G as in George, R as in Robert, M as in Mary, A as in Apple. Again, GRMA Inc.com, correct?
Yes, Inc.com.
Now, that's a way to reach out to Sam Won. Last name is WON. Sam, I'm not sure if you're on LinkedIn, but I would recommend that people also follow you there. I don't know if you check DMs, but at least they could follow and get some of your content. And for those of you that want to go a little step further than just filling out a form online or even looking up the phone number and giving Sam a call, hey, I heard you on Angelo's program or podcast, specifically for my members, I will absolutely highly recommend an introduction. All you have to do is reach out to me, which by now I think everyone knows how to do that. And I am more than happy to make a specific intro to Sam. Everyone, I'm Angelo Robles at Family Office on YouTube and Twitter. My website is my name, angelorobles.com, and learn about membership. We're still accepting, now you may hear this, it may be a little too late, what's called charter membership, and then the pricing goes up, and that's probably going to happen well before the end of the 2024 year, but it still is going to be an incredible opportunity. So go to angelorobles.com and learn more about membership and the other programs that we offer. Follow me on LinkedIn and at Family Office on YouTube. And we look to always be an obsessed resource dedicated to the single family office community. Sam, thank you so much for coming on for a long form interview. I look forward to seeing you soon. Thank you for your time.
Thanks, Angelo.